Trump has always wanted more rate cuts. We've seen it go from adding nearly 2 lakh jobs a month to now ending up at around 22,000 jobs in August. It also puts a brake on the economic growth, which can also cost jobs. There is a basic economic lesson. When inflation is high, central banks typically raise interest rates. This makes borrowing pricier as mortgages, business loans, all of these things cost more. This slows spending as people and companies pull back. This makes borrowing pricier as mortgages and business loans start costing more. This slows spending, which means that people and companies are pulling back, which ultimately means that the demand is cooling. And all of this means that prices are typically easing off, and that is cooling down inflation as well. But the US inflation is sticky and is expected to end this year roughly above 3%, well above the Fed's 2% target. And unemployment data and other economic indicators are showing that the US is slowing down. So we have high inflation, we have slowing growth, and potentially rising unemployment. All of this is a classic case of stagflation. So why did the US Fed go out and cut interest rates when inflation is rising? In today's video, we'll look at 5 things. We'll look at what is an understanding stagflation a bit. We'll look at the US jobs market. We'll see if rate cuts can actually solve the US unemployment. We'll also look at if the Fed is being pressured into cutting rates. And finally, we'll look at what has happened historically when rate cuts have happened in both expansion and recessionary periods. So the Fed has dual mandate. It typically looks at maximizing employment while also ensuring that the price or inflation is stable. Now, right now what's happening is that both of these two goals are going in opposite directions. The concern here is that if they cut rates while inflation is already very high, that poses a real risk, which means that there could be a runoff inflation or a runaway inflation. And this has happened in the 1970s when inflation was allowed to run very hot to basically devalue the huge national debt that the US had taken on, which meant that they could pay them back at a cheaper rate because the dollar was cheaper. It was a very risky play back then, and it still is a very risky path today. And the US Fed has deliberately kept these rates up in what is known as a restrictive territory since early 2023. Basically, what they've done is kept borrowing more and more expensive to try and slow down things and ensure that inflation cools off. Now, the Fed has cut the rates by about 0.25% in the territory of 4 to 4.25%. When the consumer inflation that we have seen has hovered roughly around 2.9 to 3%, and PCE inflation has also hovered roughly in that 2.5 to 3% mark. So by lowering rates, it means that they can create maybe more jobs, there is more economic buzz, but it comes at the cost of risk of higher inflation. And when rates are risen, on the other hand, this typically helps control inflation, but it also puts a brake on the economic growth, which can also cost jobs. So what is happening to US jobs? Well, the US job market is falling. There's been a pretty stark shift in the US labor market. We've seen it go from adding nearly 2 lakh jobs a month to now ending up at around 22,000 jobs in August. So the big question here is, why are US jobs seemingly disappearing? Now, it's a worrying picture for the US. The labor market seems worse than what we had thought about previously. The New York Fed had done a poll which suggested that less than half the people felt confident about finding a new job if they lost the current one. So what is happening? Well, one, companies are holding back on hiring. There's so much uncertainty with tariffs, trade policy, immigration rules, inflation rising up. Nobody really knows what's happening next. So companies are being conservative. They're being very prudent, and they're sort of putting a pause on any expansion plans or growth plans that they had. Second is that costs are a huge factor for these companies, right? Businesses are dealing with higher import costs, all thanks to Trump's tariffs. There are supply side issues because of the tariffs as well. And when you have this sort of very high cost of that talent, especially in a high rate interest rate environment, it means things are going to cost more and more. Finally, there is AI. Companies are actively looking at what can bring down their costs without necessarily hiring someone. And especially we're seeing this in that sort of new entry-level jobs that are typically there. So the question here is, can interest rates change or fix the US unemployment problem? Well, lowering rates in theory has meant that you can create more jobs, because if it becomes easier for companies to borrow, or if it's cheaper, it eases the burden that's there from the debt side for the business. This could give give them confidence to take on extra risk, which makes that investment, whether it's hiring people, buying more equipment, etc. But the US economy seems to be currently in a supply side shock phase, right? We're seeing pandemic in the last 4-5 years. We've seen wars that have affected energy prices. We've seen the new Trump trade tariff, which is causing supply chain issues, and like we discussed earlier, AI adoption as well. So the Fed cannot directly fix supply side price shocks using just interest rate changes to necessarily fight both inflation and also boost the labor market. So given all of this context, there is a question that has been hovering around the markets. Is the Fed cutting rates now under Trump pressure? Markets love certainty, but the Fed's actions have a perception of uncertainty. Trump has always wanted more rate cuts. He wanted a rate cut nearly 12 times as higher than what we have seen currently of the 0.25% cut, which means they're basically demanding the Federal Reserve to put their foot down on the accelerator to really jumpstart the economy, in his view. And what this does is it really seriously raises the question about the financial integrity of the Fed and about its institutional integrity as well. So on the one hand, you have solid economic reasons that are such as soft labor data, rising inflation, that are leading the Fed to take a certain action. But at the same time, what we're seeing is because of the political atmosphere that's there, a lot of these changes or decisions might be being taken in that framework as well. And many are arguing that the Fed might be losing its integrity, that sort of perception of independence, which is really bad from a longer term economic stability perspective, because it erodes trust, which is something that the US market, the US Fed is known for. And when you layer all of this sort of political aspect of it on top of what is already happening in terms of the ongoing government spending cuts, the uncertainty around trade wars, the housing crisis in the US, the energy crisis that's happening across the world due to geopolitical tensions, it makes for a very interesting mix of things from an investor perspective as well. So when the Fed starts cutting interest rates, what happens to the stock market? Well, historically, the US equities have outperformed both bonds and cash over the next 1 year horizon. When we looked at the 22 sort of main rate cutting cycles that have happened since 1928, the real 12-month average data showed 11% for stocks versus 5% for treasuries, 6% for corporate bonds, and ultimately 2% for cash, which means that equities does perform better. But it does matter when these cuts happen. Does it happen during a recessionary period, or does it happen when the economy is in an expansion mode? And that regime matters. So the outcomes that we see are typically stronger when the economy avoids a recession, with stocks showing nearly 17% returns, whereas when the cuts have happened during or amid a recession, the returns from stocks have been lower at about 8%. And typically after the first cut during the recession, the next 3 months often show a lag, while cuts in expansion tend to see the index up by in the 6 to 12 months period. So drawdowns are also shallower in these sort of expansionary phases, whereas in recessions, they're not as shallow. They sort of persist for a longer period. So what are our final thoughts? Well, rate cuts for the Fed, for central banks, are typically a tool. They're not a cure for what's happening in the economy at a broader level. Today's challenges, such as the energy crisis, the tariffs, housing crisis in the US, supply chain issues because of trade wars, the job restructuring that's happening because of AI-driven work, are typically things that are resting outside of the Fed's core reach. And cutting into, let's say, sticky inflation risks, igniting the fire, refusing to sort of cut risks deeper, potentially, a longer labor force damage. And ultimately, the nightmare scenario for the Fed and for central banks around the world would be entering a stagflation situation with all of this in mind. So for investors, the history does show that equity does do well when interest rate cut cycles have happened, especially if they're outside of recessions, and that's something to be wary of, given that the US could be entering a recession based on economic indicators. But the real scare here is from a stagflation perspective, and the real thing that you can do here is to be disciplined, because that is what ultimately helps you invest from a long-term perspective. If you like today's video, do like, share, and subscribe. If you want us to cover anything that's more interesting, that's more in depth, do let us know in the comments as well. We'd love to do it. Thank you so much for watching today. Happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.